All right, everyone. Well, thank you for joining us here for the next edition of Moving Beyond the Coronavirus Economy. My name is Tom DuFore. I'm the CEO of Big Sky Franchise Team. And today's session is our monthly recap of what's going on with franchise sales and marketing trends and just things for us to be paying attention to, oftentimes more on a macro level. And for those of you tuning in, thanks for hanging in for us getting started. We had some technical difficulties here, just with some computer glitches and bandwidth issues, but I think, fingers crossed, we have that sorted out now. So hopefully I am coming through loud and clear. And if you are new to our series here, and specifically to this now monthly presentation, we like to review and go over what we'll cover today. We'll go over some macro level economic indicators and some things that are going on, what's happening there, and how that can apply to and impact what we are doing, on a for our franchise sales, for our franchise marketing, for all of these different things that this could be applying to for us. So in any event, let's go ahead and jump into this here. I'm going to share my screen. And by the way, if you have have questions, comments, ideas, things you want to talk about, please do not hesitate to click on, type into the chat box, type information in. Be happy to support you and help you through that, and answering those questions. So let's go ahead and jump into it. I'm just pulling up one other document here. Maybe it's going to load for us. And here we go. All right. So I'm going to share my screen. All right. So the first report I always like to start with, if you've joined us before, you know this is one of my favorites, but this is the Purchasing Managers Index report that's released once a year. It's put together by the Institute for Supply Management. And this just gives us an understanding of what's happening in manufacturing. This one is the Manufacturers Index. They do a few of these, so we'll go over them. But what this reviews and goes over is, what are the purchasing managers doing for manufacturing companies? Are they buying more goods, services? What's happening? And we see here for the month of November, this data was just released here within the last week or so. And we can see that manufacturing grew. It says on this website here, it says manufacturing PMI at 61.1%. And manufacturing grew in November as the manufacturing PMI registered 61.1%, a 0.3 percentage point higher than the October reading of 60.8%. The manufacturing PMI continued to indicate strong sector expansion and U.S. economic growth in November. All 5 sub-indexes and that directly factor into the manufacturing PMI were in growth territory. All of the 6 biggest manufacturing industries expanded. And so you can see that. Now, when you're looking at this graphic, if you're just listening in and not watching, anything that is above the 50 percentile marker on this, that means that the manufacturing economy is at a break even. So anything above that is generally a very positive indicator, and anything where it's either trending up, and you can see the trend really since back in maybe May or June of 2020, a consistent steady growth trend going up. So what does this matter to, how can this factor into your franchise marketing, into your franchise sales efforts? Well, when you're speaking with candidates, one way can be, if someone's concerned, maybe they're saying, well, I'm concerned about the economy. They've heard a lot about maybe people, the great resignation as it's being called now, or they're seeing what's happening with inflation and different things in that regard. You can point to this as a macro indicator. Generally, generally manufacturing is a leading indicator, which means when manufacturing is going well today, that means many months, maybe years from now, things are going to be still going well. So this could be 6 months, 12 months, maybe 36 months into the future. We should see the ripple come from this as in a positive way. So that's just one thing to point out. And you can talk about that growth opportunity that looks like things are still trending in a very positive direction. Here's a really important one too. The United States is predominantly a services-driven economy. And what you see here is that for the Purchasing Managers Index report for the services sector, in November, the report says here, in November, the services PMI registered 69.1%, a 2.4 percentage point increase compared to the October figure of 66.7%. This is the highest reading since the inception of the index in 2008. So the highest reading in 13, almost 14 years. The 12-month average is 62.1%, which reflects strong and sustained demand in the services sector. The November reading indicates the services sector grew for the 18th consecutive month after 2 months of contraction and 122 months of growth before that. The point being, services is surging, which you've probably known and seen. You can see this, but look at this huge surge. If you're looking on this chart here, if you're tuning in, you can see that the last 2 months in particular, you can see this big rise from in October, and now November, just a big boom heading up. It's trending up. So these are all positive indicators for us about things that are happening and going on. So next report that's put out by the Institute of Supply Management is the hospital report. And so this is their newest report that I'm familiar with. And it says the hospital PMI registered 64.5% in November, the highest reading since July 2020, and an increase of 1.1 percentage points from the October reading of just lost my place, of 63.4%, indicating the 18th consecutive month of growth. The business activity and new orders indexes increased in November compared to October, while the employment index remained in contraction territory. And so this very well may be some of the issues that have been going on with the news with nurses and medical professionals exiting out of the medical space, whether it's just leaving entirely or for feeling burned out, a wide variety of issues happening there. The case mix index increased to 55.5%, up 1 percentage point compared to the October reading of 54.5%. So as we look at this chart here, we can see that the trend at 64.5% is up. Again, in all of these reports, a 50% reading means if you're above that, that's a positive sign. If you're below, it's really in questionable territory there, that it's trending in the wrong direction. So at 64.5%, it's a very high, healthy reading, and the highest since, as the report said here, since July of 2020. So last month I introduced, we can talk about, I just want to add into here, how can you talk about these 3 different reports? Well, you can talk about them in the same regard. You can showcase hospital, services, and manufacturing all positively trending in the right direction. These are great indicators about where the economy is headed. So when you talk with candidates that maybe are nervous, they say, well, I don't really know. How am I for sure? Well, again, nothing is 100%. We can't predict the future, but these indicators help give us some comfort level in making decisions. These past performance and these indicators are telling us something. So just something for you to be talking about and reviewing with your prospects, with your candidates, might even be able to talk about it. Here's another data set that's really, really interesting. So this is really geared on the marketing front. So this is something for you to be aware of on the marketing side. So this is from the Bureau of Labor Statistics, from the U.S. Census Bureau, from the U.S. Census Bureau. And this is the business formation statistics for November of 2021. Now, this is a report that I was doing some research and found last month or month or two ago. I ran into it and I introduced it last month. I love this report. It's really phenomenal from a marketing standpoint of you looking to recruit and find prospective franchisees. And so this was released December 8th, and it says The U.S. Census Bureau announced the following seasonally adjusted business application and formation statistics for November 2021. The business application series described the business applications for tax IDs as indicated by applications for an employer identification number through filings of the IRS Form SS4. The business formation series describe employer business formations as indicated by the first instance of payroll tax liabilities for the corresponding business applications. So basically, these are applications for federal EINs. All right, here's why this matters. And this is really cool. And I love this chart off to our right if you're looking at this. So you see the top line. So this is the total applications, the gray chart, the gray filled in gray and that filled in yellow or goldish color that it is there. And you can see since the recovery from the shutdowns started to happen back in mid 2020, you can see the surge of applications. There was a consistent trend of new business applications. It was hovering just below about 300,000 monthly applications. It looks like really since about the end of 2017, all the way up until until the shutdown started occurring in early 2020. And then mid 2020, we see this huge resurgence and literally a greater than almost a 30% increase in applications. We're now seeing a massive increase. And just last month, I'll scroll over to the left here. You can see the total U.S. business applications of over 432,000 business applications. Okay, that's about 130,000 applications greater than the pre-pandemic level of about 300,000 per month. And why does this matter if you're in marketing? That means future business owners have opening a business on their mind and they're taking action on it. So that, at least in my interpretation, that's my interpretation of this data, what you should be thinking about. This means that people are thinking about starting a business and they're taking action on it. And I know that some of this 432,000, some of these are franchisees that are opening up. A lot of them are going to be independents, of course. But 432,000, high propensity are 144,000 with planned wages, 52,000, and from other corporations, 53%. Now, it shows a decline or a decrease of 0.1%, but that's comparing month over month. So it was a 0.1% decrease from October of 2021. So a 0.1% decrease. When I see a percentage number like that, it's not a huge increase, for the volume that's coming through. It means it's pretty flat, all things considered. And even when you look at the line here, you can see October to November, you have these 2 months. And basically, the line's flat right there. It's just kind of staying about steady. And you can see where this is happening. For total new openings, the western region of the U.S. really led the growth month over month, comparatively month over month. So we see the U.S. as a whole was down 0.1%, Northeast down 0.7%, Midwest down 0.2%, the South was down 0.9%, the West was up 2.3%. So I think that this is a really cool chart, really cool information. And I think that in your marketing now, you will want to be discussing and talking about things. Just would be my recommendation that you talk about how your franchise opportunity, that now is the time. And we always say now is the time, but truly now is the time. You've been thinking about starting your own business for a while. Now is the time to take control of your own destiny. And now we're another year removed. We're coming up on 2 years since the shutdowns and the coronavirus situation really hit nationally and globally. And people are starting to accept, I think, my opinion, that people are starting to accept or maybe realize that, this is just kind of the world we're in now. So there's maybe a greater comfort level. The uncertainty isn't as high as it had been previously. So I think that this is a really good time that we may see another surge of applicants. Oftentimes in franchising, we see a big surge in leads of interested franchise buyers in the first quarter. So I'm hopeful that we start to see that. So this is a new report. No, actually not totally new. I've talked about this report in the past. This is the U.S. real estate market outlook that's produced by CBRE Incorporated, if you're familiar with CBRE in the commercial real estate space. And they put together a comprehensive report. It's 41 pages. It's awesome. It's thick, full of just really, really great data. And a couple of stats. I'm not going to go through the whole report here, but there are a few figures I want to talk about here. So this is on page 6 of that report, and it says the growing economy to fuel commercial real estate's recovery. And the prediction for 2022, they are predicting about a 4.5% growth over 2021. So this is the trend that's being predicted for 2022 for the forecast for the this is the US GDP growth CBRE house view. So I think that that's interesting to see what they're showcasing here. And then I'm going to show you a couple of key figures on real estate space. Scroll down here a little bit. Okay, investment volume is approaching record territory. So commercial real estate investment, it says here on page 11, commercial real estate investment activity roared back in 2021 thanks to strong investor demand and abundant capital flows. Capital availability will continue to support a buoyant acquisition market in 2022, with equity capital targeting U.S. real estate near all-time highs and low-cost financing readily available. More foreign capital is expected to target U.S. assets in 2022 as international travel restrictions ease and costs to hedge against dollar appreciation remain very low. Total investment volume in 2022 is projected to increase 5 to 10% over 2021 levels, which are on track to roughly equal pre-pandemic volumes from 2019, which is currently the highest annual total on record. So that means 2022 is projecting to be equal or exceed what the previous record was for total capital investments, according to this report here. And so what does that mean? Well, what that means from a real estate front, that means it's bubbling. Lots of things are going on. I mean, and we see real estate prices increasing, commercial real estate as well as residential real estate. So that means new commercial real estate coming in. And then I want to show you here's the office forecast. So asking rent percentage growth, they're showing the trends that it's for it says on page 15 here, it says occupier favorable market conditions to persist. Throughout 2021, new lease transactions increased from pandemic lows. Negative net absorption diminished and sublease space began to recede amid strong job growth nationally. These trends will accelerate in 2022, fueled by the expected creation of 1 million new office using jobs, resulting in nationwide positive net absorption for the first time since Q1 of 2020. So, and then it says, the next paragraph says, the improvement in office demand will be greatest in markets hardest hit during the downturn, including Manhattan, Chicago, Seattle, and Dallas. So keep on the lookout for that. If your business or businesses rely on office foot traffic, maybe you have a restaurant or something that relies on office foot traffic, this is a good news for you, and something for you to be sharing or talking about with your franchisees. And certainly part of the contributor is this hybrid working environments and shared office space. And now let's talk about the retail side. So this is really what I wanted to get to. This is on page 19 of the CBRE report, and it says retail's recovery stokes optimism and investment. And it says the next paragraph, the retail sector is recovering relatively well from the pandemic's major disruptions. Existing retail space is more efficient with sales per square foot, improving due to few new stores being built and rising retail sales. The mall sector, thought to be in deep peril, is experiencing foot traffic above pre-pandemic levels and reporting double-digit sales growth. Investors, meanwhile, are taking a fresh look at retail's attractive yields compared with other asset classes. So this sentence here is important. Investors are taking a fresh look at retail's attractive yields compared to other asset classes. That means real estate investors are reconsidering retail as a viable investment option for them. Maybe a bunch of contributors, maybe rising costs in commercial space, but the fact that retail is coming back is a good thing. In addition, record levels of venture capital are targeting retail-focused companies. So now you have investment capital coming into retail-focused companies, which drives expansion, which drives increase in these retail spaces. So what does that mean if you're in the retail business of any kind and franchising? Well, it means that you have other competition. So maybe there's been an idea or a thought that maybe there still might be vacant spaces or availability of retail location happening because of the pandemic. I think those days and ideas are long gone based on what this report is saying. And you have more competition because venture capital is coming in. You have a huge increase in, based off of here, you have this huge increase of new startups. Now, not all of them are going to be in retail, but a lot of them will be retail and food and so on. So I'm jumping back to the report now. And you have all of these factors coming together into one type of this kind of convergence. So what does that mean? That means that prices are only going up. One other variable I forgot to mention that the CBRE report mentioned is that new builds for new retail space has been slowed or stopped during the shutdowns. So that means that you have all of this, you only have this limited supply, new inventory is not coming or not coming fast enough or anytime soon. So that means limited supply, increased demand, which only leads to one thing. When supply stays constant and demand goes up, price goes up. So your price is going to go up. There's limited supply. That's inevitable. So the point is, this was a very long-winded way of getting to the point that if you're in the retail space and you have franchise candidates that are interested in your business, you need to strongly encourage them to be moving quickly. If they're going to do this, now there's a difference between someone who's maybe just hemming and hawing versus someone who's genuinely a serious candidate for you. And if they are that serious candidate, it is truly in their best interest to be looking to secure a lease sooner in the retail space rather than later, because this convergence is happening. And look at this huge spike in total sales per square foot index, and just a limited amount of supply with increased demand happening. So it's in their best interest and show them these kinds of reports and this kind of information to say, I'm not making this up. This is inevitable. This is what's going to happen. These trends are are indicating this happening. So things for you to think about here. Okay, now let's jump into the franchiseinsights.com website. I love this website and the data that's put out by Franchise Ventures. Thank you, by the way, for your continued effort, Franchise Ventures, and all the folks over there that are compiling and aggregating and putting together these reports and data and information. It is absolutely phenomenal. So here's a report that shows startups planned for first quarter of 2022 reach highest in 12 months. So startups plan for the next 2 to 3 months out of highest in 12 months. Let's see here. So if you look at this right bar, this is going to show you the growth here. And this blue bar shows that 34% of the respondents indicated they planned to start up a business in the next 2 to 3 months. So that's a big increase, big increase. And almost 2/3 of people, it says 62, it says here, this was from December 2nd, this was published. Almost 2/3 of entrepreneurs, 62.2%, agree or strongly agree that now is a good time to start a business in November 2021, a second month of descent from September's high of 73.4%. Aspiring owners who anticipate starting their business in the 2 to 3 months out range reached the highest level since October of 2020 as the Delta variant emerged. In addition, 84.6% of these aspiring owners see business conditions about the same or getting better in the next 3 months. So all of this data and information seems to be communicating the same type of information back to us. Let's take a look at, oh, hold on. There was one other up here I wanted to, startups planned. This is what I wanted to show. Benchmarking shows 62, this is from Franchise Insights again. Benchmarking shows 60% of franchise lead generation budgets growing in 2022. So it says over 93% of franchises expect to spend the same or more in 2022. And if 62% of them are planning on spending more, 62% of franchise companies, this is getting into franchise marketing, are planning to spend more. That means if you're spending the same, you're losing, opportunity, because companies on average are planning to spend more. Or if you're spending less, you're going to continue to get a reduced share of the available candidates that exist out there. So this was published December 9th of this year. It says which was, well, what's today? Today's the 15th. So this was 6 days ago. In a survey conducted December 1st to the 8th, 2021, 61.7% of franchises responded saying that they expect to spend more or much more on franchise leads in 2022. Confidence in a better 22 is seen in franchise systems in all stages of growth. So that's going to mean franchise stages of growth means emerging brands, mature brands, enterprise brands, and growth brands, all of any stage of franchise growth. Active U.S. franchisors responding to the benchmarking survey hailed from a representative spectrum of categories and system sizes. So I think that this, and here, listen to this quote. It says, quote, with pervasive vaccines and a favorable business environment, franchises are gearing up for a big year, unquote, said Hunter Stokes, president of Franchise Ventures. Quote, 2 years of pent-up demand and a robust pipeline of aspiring franchisees will combine to make 2022 an unparalleled year to invest in the future, unquote. This is back to the article. It says, plans to remain or increase spending were strong across emerging, established, and large franchise systems, according to the survey of the Franchise Ventures demand generation platform. So this is just interesting data. And so if you are in the franchise space, in franchise marketing, franchise sales, if you're in franchise sales, understand you're probably going to be getting an influx of leads. And you're going to also, if you're spending more, if you're working for a brand that's spending more, you're probably going to be getting more leads coming in. Hopefully that leads to more opportunity for you. And if you're managing the marketing budget, please note about these things that are happening and coming through the pipeline, that businesses are increasing their marketing budget, that they are spending more on franchise lead generation. So that means your competition is increasing as well. Even if the number of competitors doesn't increase, stays the same, they're spending more. So you need to consider that into as you factor into your own marketing spending. Okay, now the second to last report here. No, I'm sorry, third to last report is the Small Business Startup Sentiment Index. We've covered a lot of this. This was published December 2nd, and this is through November of 2021. And this is a really good report here. It shows that outlook on business conditions are more positive. And so this comes from page 2 of the report. And it says the sentiment about starting the business now versus 3 months ago. Fewer respondents, it said, are upbeat about starting or buying their business than they were 3 months ago. In November, 58.5% of those responding indicated that they were much more likely to start a business now than 3 months ago, compared with 68.9% in October of 2021. So I think that's a really great takeaway. That means people are thinking more of starting that business. Okay, let's go to startup intentions within the next 6 months. 75.7% of the respondents said they intend to start up in the next 6 months. So 3 out of 4 people reported. I think that's really, really good. I want to go down to, here we go. Which of these factors will have the highest impact in the next 6 months on your decision to start a business? And so I always like to point this out. I'm going to zoom in on this chart a little bit. It's hard to see. This is on page 5 of the report. But this is for November of 2021. And if you look at this, if you're looking at this chart, it's clearly the two highest categories consistently over the last year and a half or so show that funding or access to credit by far is the number one concern for people that's making an impact on their willingness to make a decision to start a business. And at 71.5% in the month of October, it's this black line if you're looking at it here. Of 71.5% of the respondents said that they're concerned or that funding and access to credit is going to have an impact on their decision to start a business. And then the second highest number is economic climate, which is 34%. So it's interesting to see that about 1 out of every 3 candidates says that they're concerned about the economic climate. And inverse that means 2 out of 3 are not as concerned about the economic climate. That's a positive thing for you. However, almost 3/4, almost 3 out of 4 candidates that are coming into your pipeline are concerned about funding. So these are 2 topics that you should be talking about, at least trying to inoculate in your sales presentation. Access to funding is an obvious one that you should have as part of your presentation regardless, but you want to make sure you're talking about it to say, well, what's your plan for funding? Do you have a plan? And help support or give them ideas, suggestions, referrals to maybe some of the franchise funding organizations that exist. And then the economic climate, be talking about how your franchise system is going to help them with this concern of the economic climate. The good news is, if you're looking at this report, since the pandemic hit, you see that the economic climate concern has continued to trend downward as a whole. It's trended down over the last year and a half. So that's a positive thing to see happening there, but it's still a concern for 1 out of 3 people on average. So that means you want to be talking about it, which is why using some of these economic indicators we're talking about is important. Lastly, let's just talk about the unemployment rate. And unemployment rate fell by 0.4 percentage points to 4.2%, according to the U.S. Bureau of Labor Statistics. And this report came out on December 3rd. And the total non-farm payroll rose by 210,000. It rose by. So, pretty straightforward, seeing a continued decline. Obviously, the bigger issue at hand right now is hiring people, training people, and really retaining people. And a great article I read last week talked a lot about not just finding new staff, but not forgetting about your current staff and doing what you can to retain your current staff so they feel like they want to stay with you and not go work somewhere else, because they know opportunities exist. So make sure you're talking to your staff there. And with that, I'd love to open things up to questions, comments, any comments, questions from the audience while we're still here. Go ahead and type it into a chat box, raise your hand. I know we've got a few other folks on the line here. No questions or comments or anything coming in. Okay. Well, I would just like to thank everyone for tuning in today. Thanks for being here. This will be published online probably over the weekend or sometime by next week. So if you want to share this with someone, it will be published on YouTube. It'll be available on our website, on our blog, and for you to watch again, share with someone who might need to see this, or just share with your team or have information to be talking about. Thank you all for being here. Have a great weekend. And this, by the way, will be our final presentation for moving doing Beyond the Coronavirus Economy series for 2021. So have a Merry Christmas and Happy New Year. Thanks for being here, and we look forward to seeing you back in January.